What's up, YouTube? It's Joe Catapaglia sitting on the couch making some money investing in fractional real estate online, as usual. I got some interesting news from Mogul today, and that has also led to a new property launch. So I'm going to do a little bit of analysis on the new property, which is a Padsplit in Houston. Before that, I just want to tell you what led to that. So I had invested in the Malone, which was the last one I had put money into, I think. It was the Virginia Padsplit. Unfortunately, it sounds like after they did their inspection, they negotiated some concessions, and then even though that was agreed to, later on the seller realized that he wasn't going to net as much from the sale as he wanted to, and he backed out. Even though the people at Mogul believed the seller was in breach, they didn't think it made sense to sue for specific performance to force the sale. I tend to agree with that. In the 20 years I've been investing in real estate and an agent, I've literally never tried to sue to make a deal happen. It's something that you can do, but it costs, it costs time and money. When they're investing for, us as third-party capital, I'm glad that was their decision. So they said, okay, you can have your money back today, or just let us know and we'll roll it into this next property. And this next property is the Wabi Sabi. Sounds like they did everything right. There's sometimes you run into sellers that just don't fully understand what the deal is. This is one of the situations where if maybe I was involved, if I were buying this personally and I didn't have to worry about, what other people expected, like I've gotten to the day of closing, had a seller say, nope, I'm not selling, and was able to negotiate a new deal that I was happy with. I was the buyer. It was not, we still worked something out. We got a little bit creative. But I didn't have investors in that deal with me, right? That I had to make sure they were getting the same deal that they had signed up for originally. And so that's one of the things that we might run into a little bit more often, where obviously they are negotiating on behalf of our entity that's buying this, but at the same time, if the deal's changing too much, and maybe there wasn't anything that could be done, right? Maybe there wasn't some creative solution or some sort of trade-off or anything like that. It's possible some deals just die completely. But it is, I'm just glad to see they're not just, pushing forward at all costs, right? Because I could imagine a scenario where they said, hey, we already have their money. Let's try to sue for a specific performance, and we get this deal done, right? Like, I think that is, it's a possibility that somebody who wasn't thinking about the investor's best interests, they might actually do that, right? So I'm pleased with that decision. And now let's talk a little bit about this property. It is a 10-bedroom, 10-bathroom, purpose-built pad split in Houston, Texas. This is starting to sound familiar, I'm sure, because we've seen other properties like this. If you remember, I did a video on the Rock House. I'm going to put a link to that video in the description to this video. So if you want to just check that out, I'm going to skip a whole bunch of the analysis because this is literally, so this is the Rock House, and now we're looking at the neighboring property, the Wabi Sabi. There is going to be, there's some differences, and so I want to talk a little bit about that. But first I want to mention in the description of this video, I'll put a link to the Rock House. I think a lot of the analysis I did in that still applies to the Wabi Sabi, and it's, if you're a little bit of discussion on the market or on the neighborhood and all that stuff, you can see it there. Also, in the description of this video, I've got links to all the places where I currently invest in fractional real estate online, like Mogul, Lofty, all the other places. Please feel free to use those links. But if you do your own due diligence on those platforms and on any properties you see on there. Just because I'm using a platform or buying specific properties doesn't mean that you should. So you want to do your own due diligence on that. And before I forget, also please like and subscribe. Okay, so like I said, I'm going to really skip over most of the info because let's look at this: 10 bedrooms, 10 bathrooms. The Rock House was 10 bedrooms, 10 bathrooms, same square footage, right? 24. Same purchase price, $635,000. The And the Greg was, I think this is the Foundry, which was or is that right? Maybe. Let's look for one more. Let's see. Open the analysis tab. Open the tab. I'm trying to think about which one the Greg Street was that they paid $635 for. Because, okay, so we have this one, the Rock House, the Foundry, yeah, and the Art House. So this one was a 9-bedroom, 9-bath, and I think the Foundry was a 10-bedroom, 10-bath. This one, I think we're going to have our first dividend tomorrow, so you'll get to see how this performed. Yeah, this was 10-bedroom, 10-bath, same exact floor plan. Yeah, this is the Greg Street. So this one, they actually, had originally said they were going to buy it for, do we have it here? Yeah, they originally said they were going to buy it for $650. I guess they actually got it for $635. So here they used that as the only comp and said, okay, we paid $635 for that. And so then on this one, they only, they showed the Foundry $635. I'm actually not sure why they didn't include the Rock House. Maybe the Rock House hasn't actually closed yet. Is that what's happened? Okay, yeah, because this is supposed to close in next month. So the Rock House hasn't even closed yet. But so this is what's really interesting here. The Wabi Sabi, so everything is the same, right? It's 2 properties, same square footage, same bedrooms and same bathrooms, right next to each other. Average yield on the Wabi Sabi, 12.8%, 13% IRR. The house right next door this just sold like a month ago. They just raised the capital for this a month ago. Average yield, 14.9. Average annual IRR, 16.7. So you can see their thought process, okay, what's going on here? Why is the neighboring property going to do so much worse? There's no real explanation for it if you read income growth. Yeah. But so I want to show you a couple of things. Okay, let's see. We got to go to the analysis tab to see where that difference is. So cash flow assumptions, yearly rent on the Wabi Sabi, 100,000. What are we doing here? 100.8 thousand, right? So that's 100,800. Where for the Rock House, oh, what did I do here? Open the wrong tab again. I've got too many of these. They all look the same. 108,000, right? So these numbers at first they look similar, right? It's 100,800 versus 108,000. So they look pretty similar, but they're not, right? So it's $7,200 less in annual rent that they're projecting, despite the fact that they're just identical properties next to each other. My only guess is that they have gotten more info about the rental market because they have since purchased. Let's see. Yeah, this is the Foundry, right? So this is the one that they've actually closed on. Let's make sure that's the case. Oh, that's going to be in the other tab on this. So okay, we've got to open one more tab. Open like in a new tab. Sorry about that. Obviously not quite as prepared as I should have been for this. And now that's going slowly. But so, let's see. We've got the Foundry here, right here. And let's see, what were we checking? When did they actually close on this? Purchased in October. Okay, so this has actually been closed on, right? And here they had the same thing, right? 14%, 16.5, which is what they were projecting. 14.9, 16.7. So very close to what they were projecting when they did the Rock House, but again, way above what they're projecting now on the Wabi Sabi. A couple percent. I think it's a significant amount. And so my guess is they closed on the Foundry. This is very close by, and it's not going as well as they're hoping, right? Maybe there's more rental demand or less rental demand than they thought, or they have to discount a little bit more than they thought. So something there is impacting their projections, right? There's some reason they believe this one's going to do worse. And so my guess is that also means the Rock House is probably not going to hit these numbers. I don't know that for sure, but it's really hard to understand why an identical property would be so much lower, unless it's just that they now have more info on how that market is. And you can see actually too, the Foundry is a little bit more attractive of a property. There's a little bit more architectural detail color-wise, so I don't think that really makes a big difference for this sort of product. But I think it could help a little bit. Okay, top line revenue, they've had a different projection there. But also, the other thing that they're doing, okay, let's see. We've got the Wabi Sabi, just making sure I'm looking at the right one. 3% appreciation rate. What did they have in the Rock House? Oh, this is the Rock House. Yeah, I'm getting confused with all this. And so what's the appreciation rate we have here? 4%. All right, and then this one is the Foundry, and what was the appreciation rate? 4%. So they've lowered the appreciation rate that they're expecting, and they've lowered their expected year one rental income. And what else? Okay, did they change these? The growth rate of the rental income or their expenses? Let's see. Oops, again here. Nope, 3. Oh, so they did lower the growth rate, or they had a lower expense growth rate than what they have. Okay, so the Foundry had the lowest expense growth rate. The Rock House, they had already increased it there. They thought, okay, expenses might grow a little faster. And so we've got the same growth rate there. So I think that's where all of the action is happening on this deal, right? It is, when I looked at the rest of the numbers, it looked like we basically have the same assumptions for property taxes, homeowners insurance, property management. Like these numbers look the same. It's really a story of top line revenue, and I'll just show you that. Right? Yeah, 13. Let's see. 1354, 1008, 1302. Yeah, 1354, 1008, 1320. So and I think that total expense number. Oh, it's 42. Why are we a tiny bit different? 42.4 versus 41.680. That's interesting, because those numbers look the same to me. What am I missing? Oh, no. The property management. See, that's it because it's very similar, right? One way. So the property management obviously goes down a little bit when the top line revenue goes down. So that's what's going on there. So to me, that's a little bit worrisome. And if you go back and watch the video, if you haven't already, for the Rock House, I mentioned at that point in time that I was a little bit worried about, how much, about there being a lot of supply of this type of product being built, right? This one developer who Mogul is buying from built the Art House, built the Foundry, built the Rock House, now built the Wabi Sabi. I mean, that's 4. That's 40 that's 40 bedrooms in a relatively small area. How much supply, that's a relatively small amount compared to the population of Houston. And it is still a fast growing population. But that's just one developer also, right? There's been another developer who Mogul's bought a couple properties from, or maybe just investor that was converting. These ones are ground up. The other ones were not, right? They were conversions of existing homes. So I don't know if that's why they think, okay, maybe we're going to have a slowdown or a little bit less, or if it's because of, macroeconomic issues. If you haven't, if you're watching this on Thursday the 20th and you haven't signed up for Mogul's webinar, you should do that. This is the first day I'm putting this out, which was today. It'd be a good question to ask them, right? Why do we have different projections? What's changed, right? Both the appreciation and the top line revenue. Is it because of macro factors in the economy? Is it because of, when you have two properties right next to each other and you're not expecting them to appreciate at the same rate, and you paid the same amount for both of them, I don't know. It's a little concerning to me. So, I'm not sure. Like, obviously, if you already own some of the Rock House, I'd be, it's concerning that it hasn't closed yet, and it seems like maybe it's not going to be the deal that we expected. But on the flip side of that, these are all just projections, and we've also seen Mogul be very conservative in the projections that they're making on, when I look at the STRs and I look at like, okay, what did it do last year? So we're often seeing them be conservative. Now, all this new construction, they don't have a year of history to be able to look at. So they are just truly making projections. And so I think it's possible that you're still going to hit they're going to hit these numbers, but that they just want to dial it back a little bit because they thought maybe they thought, okay, we're actually going to outperform these. And it turns out maybe that's actually just where we're going to end up. So I wouldn't panic just yet if you already invested in this, right? I don't think necessarily this is the actual return you're getting as far as average yields. And projections are just that. Very early in my career, I was working with a group that does a lot of private equity investment in real estate and doing some financial modeling for them. And one of the guys there that had been there for much longer than me, he was one of the founders of the company, told me, he was like, what do you know about all financial models? What's the one thing all financial models have in common? When we're making projections of the future. And, I had no idea what he was talking about. I was a new guy. And he said, well, the one thing they all have in common is they're all wrong, right? Like you're never in your career going to project, income and cash flow for a property into the future, at least not a property like this, right? I mean, maybe if it's a single tenant, triple net property, you could be a little right. But in general, you're never going to make those projections and hit it, to the penny. You're always going to be off. And so it's just a matter of, okay, how far off are we? And did we underperform? Did we overperform? And so far, because I've seen Mogul be conservative with a lot of their deals, I think it's possible that they're expecting to outperform this number, even though, maybe they're really going to come closer to this, or maybe they'll underperform on these projections. I mean, obviously we won't know until the future how this ends up. But I wouldn't, just because this identical property, they now have a lower expectation, I would say that in general, I believe they think they're not going to do as well with these as they thought they would, but I don't necessarily think that means they believe they won't hit these numbers. Now, obviously, it'd be an interesting question to ask. It does definitely, confirm my nervousness about this product type, especially where they get a little bit less aggressive on the appreciation of these properties, because it is, if the demand softens or if the pricing for these units comes down over time as more units are built, the sale of these properties is something that I worry about, right? And I talk a whole bunch about that in the video that I'm going to link below. So don't, I'm going to try to not go into that there. And again, that's where I'll go into the market and I the neighborhood and all that. So I think that's all I really wanted to say about this. Just wanted to point out how much differently this is being underwritten. Even though it's an identical property, it's really, I think, a mirror image, right? It's like the other side. But on the, one positive thing that I wanted to mention is part of my video, when I did that video, was saying, look, we don't have any control of the neighboring property, and we're like basically sharing a driveway, and that's a problem, and we're competing with them. Well, now that's kind of true, right? Because it is two separate entities, but they're both Mogul entities now, right? So even though they're not being purchased as one deal, we shouldn't see a situation where there's some preference being paid from one side or the other, or we have competing management companies or anything like that. I wouldn't expect. So that does make it a little bit less risky than I thought from that perspective. But I think basically all the rest of my concerns are going to be the same. Anyway, that's really all I have to say about this for today. If you haven't already, please like and subscribe, hit the little bell button. And until next time, I'm just going to keep making mistakes so that you don't have to.